profit in the profit and loss account, there are items that are non-cash. And remember, we're talking about what? Cash flow, the coming in and the going out of cash within an accounting period. We want to know how much came in and how much went out within an accounting period. And therefore, we need to just make adjustment for what? For things that are not cash related. So first of all, we look at what? We compare whether there's an increase or a decrease in what? In our current asset. Remember what asset? So asset can be either current or non-current asset. Now, current assets are assets that are what? Have a lifespan of 1 year. We talk about things like the stock, the cash, the prepayment, and the money in the bank. This cash at hand and cash at bank. These are example of what? These are example of current asset. So what do? We compare the beginning or the opening balance and the closing balance. Is there an increase? If it is, we'll make adjustment. Is there a decrease? If it is, we'll make adjustment. In the same way, we compare the opening balances of our current liabilities. What are they? Things like the creditors, the accruals, income received in advance. These are what? These are liabilities that we are settling them within one accounting period. So we compare the opening as well as what? Compare the opening with the closing balance. So we'll now see the adjustment. Is that an increase or a decrease? If there's an increase or a decrease, we'll make the adjustment appropriately, just like we discussed in the last period. Then the loss of sale of asset, depreciation of fictitious or intangible assets written off are to be added back because they are non-cash items that do not result in the outflow of cash. So what are we talking about here? We're looking at items that has to do what? That involve the inflow or the outflow of cash. So when there's a loss on sale of fixed asset, it's not an outflow. When there's depreciation, it's not an outflow. Fictitious or intangible asset written off within the period are not cash flow. So what do? We add them back to the profit to know or certain what is the actual profit for that period. Then the next one we'll do what? Other items which affect investing or financing cash flow, such as profit on sale of asset, dividend or interest income, etc. We do what? We adjust them as well appropriately. So now, having done with this introductory part, we're going to have a format of the indirect cash flow statement. Now, if you were following, I said the indirect and the direct method are the same when it comes to financing and investing activities or operations. But for the operating activities, that's where the difference comes. For the other one, we talk about what? Cash received from customers or from sales with less cash paid to suppliers, and then we'll get our net cash flow from operating activities. But in this very one, we look at what? The net profit before tax and extraordinary items. What is the profit that we have? So where do we get this from? We go to our income statement. We discover, we now pick our profit before tax is charged, before any extraordinary items are added or deducted. We pick that profit and then we make the adjustment. Remember, depreciation is what? It's a non-cash item. So what do? We add the following. One, depreciation for that year, we add it back. If there's a loss on the sale of fixed asset, we add it. If there's a provision for contingencies, that is, you provided that of unforeseen in the account, so we add it back. If there's provision for retirement benefits, we add it back. If there's a profit on the sales of fixed asset or investment, that is, if you make a profit on the sale of fixed asset or investment, you less it. When you have interest received, you less it. After doing that, you have what? Operating profit before working capital changes. So we have what we call operating profit before working capital changes. Then we now look at you add what? If there's an increase in current asset, that is the current asset. We talk about the trade debtors, we talk about the cash, we talk about the bank balances. If the opening balance and the closing balance, if the opening balance, let's say, is 10,000 naira and the closing balance is 15,000 naira, of course, there's an increase of 5,000 naira. So, but when the opening balance is 15,000 naira and the closing balance is 10,000 naira, it means there's a decrease of 5,000 naira. In that case, that decrease, the difference will not be added here. Then, if there's an increase in current liability, last year creditors was 10,000. This year creditors is 15,000. You now say, okay, there's an increase of what? 5,000. This increase will be what? Will be added to the operating profit before tax and working capital. So you add it here. But when there's a decrease in current asset, because some of the assets will increase, of course, some of them will decrease in value. So when there's a decrease in current assets, what do? We will subtract it and we will less it. Well, if we have a decrease, when we have a decrease in current liabilities, we will less it. We will have cash from operations. That is, after making this adjustment, we have what we call cash from operations. Now, we'll now deduct tax. How much was taxed, or how much is taxed for that particular year? The value will be what? Subtracted from cash from operation. Now, after subtracting, you get what we call cash flow before extraordinary items. This is what we call cash flow from what? Or cash flow before extraordinary item. Then we'll talk about extraordinary items. This item could be an addition. They could also be a subtraction. If there's an increase, you add it. If there's a decrease, you subtract it. Then, having done that adjustment, you have net cash from operating activities. You have net cash from operating activities. Okay. Now, what are extraordinary items in the first place? What are they? We talk about extraordinary items in accounting. We're referring to items that are things like what, like gains or losses that are both unusual in nature and infrequent in occurrence. For instance, if you are making gain of 10 million every year, and then the particular year you make a gain of, let's say, 15 million, that is an extraordinary item. And this is what it is unusual. And if it does not, that thing occur, that transaction occur, or maybe once in a while, you call it what? They are extraordinary, because they're infrequent. They're infrequent. For example, we have, let's say, natural disaster also be what? An extraordinary item. It is uncommon in that region. Let's say in Nigeria, we don't have cases of earthquake. They are uncommon. And if such happen, is what is an extraordinary item. If it happens, it will affect our business negatively. So it's an ordinary item. Then we have government expropriation. That is seizure of company's asset. If the government seizes your asset, these are things that are really they happen. They don't happen frequently. They rarely happen. But when they happen, they call what? They are extraordinary item. When we have an unusual legal settlement, if they are significantly different from what normal litigation, where you have a court law or a court case, the business has a court case that are what it is abnormal. It's an example of what? Extraordinary item. Now, if the items are reducing the value of your, if it will result to an outflow, you what? You subtract it. If it will result to an inflow, if it's a positive, you what? You add it. Then, having done that, you get what we call net cash flow, or net cash from what? From operating activities. You have net cash from operating activities. Now, this is just a format. This format is to guide us. Maybe you rehearse it, look at it carefully. You rehearse it, and then by the time you begin to do this constantly, it stick to your brain. Stick to your brain. Keep rehearsing and speak based on rehearse, practice. See, practice makes perfect. Now, let's look at treatment of what? Non-cash and non-operating activities, or expenses or reserve, how do we treat them in our cash flow statement? Non-cash items refer to those items which have appeared in the income statement as an expenditure or revenue, but they do not have any impact on the cash balance. That is, we report them, but it did not result into an outflow or an inflow of the cash. We call them what? Non-cash items. These items affect the net profit as shown by income statement without causing any inflow or outflow of cash in the business. So for instance, if we say, okay, our vehicle is depreciating by 10%, and let's say at the end of this year, we say, okay, 10% of, let's say 100,000 is what? It's 10,000 naira. We'll chart as what? Depreciation. In this case, it will be recorded as what? As an expense. And then our profit will be reduced by that amount. But in reality, that amount has not been paid to anybody, just a book entry. So we have to make what? We have to adjust for this non-cash item. If you look at the format, we add back what? Depreciation. Now, to convert accrual-based, income statement into cash-based income statement, this item must be what? Adjusted. Let's look at it. Depreciation and on fixed asset. Being a non-cash expense, this does not lead to a reduction in the cash balance in any way. I've explained this one. So while computing cash flow from operating activities, this item should be what? Added back to the net profit. I just explained this one. You add it back to the net profit. If you can see the format here, what do? We added depreciation to what? The net profit. Now we have amortization of intangible asset, that is goodwill, trademarks, patents, and the rest of them. This amortization of intangible asset reduces the net profit but do not affect cash flow in any way. So to calculate cash flow from operating activities, the value of amortization of assets should be what? Should be added back to net profit. Now, what do we mean by amortization? It's the same thing, is the same as what? As depreciation. We amortize intangible asset, but we depreciate tangible physical asset. What example of intangible asset? We talk about what? Goodwill. We talk about what? Trademark. Talk about what? Patent, and the rest of them. These are what? These are assets. They are not tangible because you cannot see them, but they exist. So if we amortize them, we are what? We have to add it back, just like the way we treated what? Depreciation. It's going to be added back to the amount of what? Profit before tax. Now, the next thing is fictitious asset written off, e.g., preliminary expenses. These also have nothing to do with what? The cash flow, but reduces what? The net profit. So these expenses should be added back for the computation of what? Cash flow from operating activities. So when you have what we call fictitious assets, when we have preliminary expenses, you have to what? Add them back to the net profit. D, what about profit or loss on the sale of fixed asset? Yes, you might sell fixed assets and then you may make profit or you will make loss. So when there's a profit on the sale of fixed asset, it should be added back to what? Or deducted respectively. When there's a profit, we add it back. When there's a loss, so the profit or loss on sale of fixed assets should be added back or deducted respectively. When there's a profit, we add it back. When there's loss, you subtract it or reduce it to the net profit figure, so that what? So that the cash flow from operating activities can be what? Can be computed. Take note, the sale of profit or sale of fixed asset, when it results to profit, let's say the asset is valued at 10 million naira and you sold it at 11 million naira. Of course, there's a profit of what? 1 million naira. What this one is saying is that this 1 million naira, it should be what? Should be adjusted in the cash flow statement under the operating activities. Now, the possibility what? You make a loss, it should be done what? Should also be adjusted as well. Now, in case a fixed asset is sold during the year, following year, following treatment should be what? Accounted for. That's if you sell an asset within the year. What do we do? First of all, calculate depreciation charge on the asset during the year by preparing what we call accumulated depreciation account to be added to the net income for the year before adjustment. Then secondly, we'll calculate amount of profit or loss on the sale of the part of that fixed asset, which shall either of subtracted or add respectively to the net profit for the year before adjustment. And then what do we do? The amount of cash received on the sale of asset must be added under the head cash flow from investing activities. Take note, the profit or loss is only recorded under the operating activities, but the sale value or the cash received on the sale should be recorded or should be reported under the cash flow from investing activities. Amount of cash paid, if any, on purchase of fixed asset must be subtracted from investing activities. Now, I hope it's clear. Let's continue. Number 5, appropriation of profit, e.g. general reserve, sinking fund, etc. All these items reduce the net profit and net profit figure without reducing the cash. So all such appropriation must be added back to net profit to calculate cash flow from operating activities. Yes, the business or the company may declare dividends. Now, this dividend reduces cash, but when we're preparing a cash flow from operating activities, these reserves are added back. These sinking funds are added back. These dividends are added back to the net profit in order to calculate our cash flow from operating activities. The next one says provision for bad and doubtful debts. This item also reduce the net profit but do not affect the cash. Calculate cash flow from operating activities. This item must be added back to the net profit. Yeah, there's possibility as an accountant or as a company, you want to be prudent. You don't want to over-report profit. So what do? You now begin to analyze your debtors. Probably you see, okay, out of your debtors, some of them are you're not sure of collecting this debt. So make provision for doubtful debt. You write them off or you provide for them in the P&L account. So into if that happens, what do we do? In preparing the cash flow from operating activities, this figure is is added back to the net profit. What about tax, provision, dividend, sales, stock purchase of fixed asset? How do we treat them? In case of proposed dividend, the provision created during the year must be added to the net profit. Yes, I'll explain this one. When you propose that you're going to pay dividend, you're going to add the back to the net profit before adjustment, and the amount actually paid during the year must be subtracted under the head cash flow from financing activity. Look at this difference here. There's proposed and there's an amount that is actually paid. When you make a proposal of dividend, what do? That figure is added back to the operating activities. But when you now pay, whatever you pay, that figure is treated under the cash flow from financing activities. In case of provision for taxation, the provision created during the year must be added to the net profit or to net income before adjustments, and the amount actually paid during the year is subtracted from cash flow from operating activities. Now, there are what we call special items, and how do we treat them? Things like interest. How do we treat interest? So interest, we have what we call financial enterprise, and that is how they are treated in financial enterprise, and then other financial enterprises, other than financial enterprise. Financial enterprise, if it is a financial enterprise, cash flow from interest paid and interest received should be treated as cash flow from operating activities. Okay, before we now go ahead, what is financial enterprise? These are enterprise that has to do with has to do with finances. Those things like this the example of what? Example include the banks, the insurance company, the investment company, the anything that has to do with what? Money, physical money. They're into finances. We call them what? Financial enterprise. Now, where there is interest payment or interest received, when you're dealing with what? A financial enterprise. This interest or receive or paid award, they're treated as what? And that as an item under the cash flow from operating activities. As I earlier said, I said financial enterprises are what? These are businesses that provide financial services. These include banking, talk about investment, talk about insurance company, talk about managers or asset management. These are what? Example of what? Financial enterprises. Now, when these enterprises, when a bank receives interest or pays interest, when an insurance company receives interest or pays interest, when an investment receives interest or pays interest, that item is what? Is treated under the cash flow from operating activities. On the other hand, we have called, if it is other than financial enterprise, what do we do? What do we do? How is interest treated? Okay, flow from interest paid should be what? Treated as what? Cash flow from financing activities, while interest received should be what? Treated as what? Cash flow from investing activities. Now, this one split into two. Now, what are other than financial enterprise? That is non-financial enterprise. What are they? These are businesses that what? That operates in industry other than what? Than financial services. They focus on producing goods or providing services or engaging in commerce rather than what? Dealing with banking, insurance, or investment. So any other business that is not dealing with what? Insurance, banking, or investment, they are not, they are what they know as what? Other than financial enterprises. What is their their primary revenue comes from what? From selling of goods or services, but not what? Not financial transaction. Example, they include business like what? Manufacturing companies. Talk about the retail, like the supermarket. Talk about the technology, the software firms, like the Microsoft, Google, social media, Meta, and then TikTok. Talk about healthcare. Example of healthcare, we'll talk about the hospital, Johnson and Johnson, the airlines, the Delta, talk about Emirates, talk about logistic, and the rest of them. This are than financial enterprises. Now, when there's a flow, when you pay interest, when this company or this businesses pay interest, the figure or the amount paid is what? Is treated under what? Fee. But when they receive interest, that amount is treated what? As cash flow from what? Investing activities. There's a distinction here. Unlike the first one, the financial enterprises, whether the cash is paid or the cash is received, they are treated under what? Under the operating activities. But this under the other than financial enterprises, what happens is when they pay interest, that item is treated what? As financing activity. But when they receive interest, it's treated as what? As investing activities. Now, how are dividends treated? If it is a financial enterprise, cash flow from dividends received should be treated as what? As cash flow from operating activities, just like the way interests are treated. While cash flow from dividend paid should be what? Treated as what? Cash flow from financing activities. This is very technical, very technical. So you have to pay attention very well. Now, for dividends, if the business, if it is a financial business enterprise, we talk about bank enterprise like what? Talk about the banks, talk about the insurance company, talk about the asset management, talk about the investment companies. So if they receive interest, I mean, they receive dividend. If they receive dividend, probably they have shares in other companies, and then that company pays the dividend, they receive dividend. So that dividend is what is treated as cash flow from operating activities. It's an inflow. But when these companies or when these businesses now pay dividend to its shareholders, that cash flow is what treated as what as financing activities. Then if it is other than financial activities and financial enterprises, that is any other businesses like the manufacturing companies, we talk about the technology, the transportation, the rest of them, the healthcare services, the hospital. If they make, if there's a cash flow from, or they receive cash flow from others, that is dividend. Sorry, when there's a dividend, when they receive dividend, that dividend should be treated as what? As investing activities. When they receive dividend, when they are not, they're what? That is when we talk about our enterprises or businesses that are into what? Buying and selling of goods, or manufacturing, providing of services. This dividend is what? When they receive dividend, as an investing activities. But well, if they pay dividend, that dividend should be what? Treated as what? Cash flow from financing activities. Note, dividend paid should always be treated in cash flow from what? From financing activities. It's just additional information for you to note. Now, how do we treat taxes on income? Taxes on income should be disclosed separately. That is, we don't have to disclose, have to show it separately in the books, should be disclosed or separately. There's also stated that it can't be identified specifically with financial activity or investing activities. Then it should be what? Classified as cash flow from operating activities. If there's a tax, and this tax, you're not sure whether it falls under financing or investing, you better classify it as what? As operating activities. That's cash flow from what? From operating activities. While preparing cash flow statement, your current year tax provision should be added back to the current year's profit to arrive at cash flow from operating activities. For instance, we'll be comparing the previous year and the current year. Now, if we have tax now, let's say this year tax is 10,000, and then this year profit is 15,000. What this point is saying is that in preparing this cash flow statement, your current year tax, 10,000 will be added what? To the present or the current year profit to arrive at what? The cash flow from operating activities. So you don't go back and pick previous year tax or previous year profit. No, you look at the current year profit as well as the current year taxes. You match them together, you add them in order to get your what? To get your operating activities, cash flow from operating activities. Now, tax paid during the year should be deducted from what? Cash before tax from operating activities. Now, if you pay tax during the year, you want to what? You have to deduct it, subtract it before you get your cash before what? You get your cash before operating activities. That's what we call deduction. You subtract it. We'll pick an example. You see all this in action. We'll see how these things are treated one after the other. You are advised to prepare provision for tax account to know hidden transaction, if any. That is, we're advised when we're preparing a statement of cash flow, we are required to work with tax account so that we'll be able to know whether there are hidden transactions. A provision for tax account looks like we have the debit side and you have the credit side. Now, the debit side, we have the balance brought down on the credit side. This is from the previous year. Let's say we're looking at two different years, 2023 and 2024. Now, these are 2 years. We have the previous year and the current year. The current year is the most recent year. Now, the balance brought down here is the amount from the previous year. In this case, we're talking about what? 2023. How much is the balance of tax? We'll put it here. We post it under the credit side. Now, we now say, okay, but in our statement, or in the income statement, how much tax did we pay? Did you pay tax? Yes, if you pay tax, how much did you pay? You make the entry on the debit side. Debit side. Now, in the current year, what is the balance of tax that is still unpaid? We call it balance carried down. You post it here. By the time you add this and this, you get the figure, and then this one should be smaller than total of this. Now, the difference between this figure, total of this one becomes of what? Your profit and loss account. That is what supposed to be in your what? In your P&L account. That's the balancing figure, the difference. And then, of course, this balance brought down is this very one here for the current year. It becomes a opening balance for the next accounting calendar or accounting period. Now, let's look at this simple example from following the extract from the balance sheet of ABC. Show how this item will appear on the cash flow statement. Now let's look at it here. We have asset, we have liability, we have 31st December 2011, 31st December 2020 and 2012. Let's look at it here. We have profits and loss account. Previous year, we have 60,000. The current year, we have 100,000. What about provision for tax? Previous year, we had 10,000. The current year, we have 15,000. Supposed to be tax paid. For the current year, we have 70,000, and then so previous year, 2,000. Then current year, we have 115,000. Now, we're asked to calculate what? Calculate profit before tax and extraordinary items. So what do? We look at this one. Okay, this is a profit for 2011. This is a profit for 2012. What do? We just find out, okay, profit during the year is 100,000. That is the current year profit minus the previous year profit. That is this 100,000 is the current year minus the previous year, which is what? 100 minus 40,000 will give us what? 100 minus 1,000 will give us what? 40,000 as what? As a profit for the year. Then we add what? Provision for tax, 15,000. But how? Okay, we'll look at what this is the provision for tax for the year is what? 15,000. Remember, we'll talk about adding that one for the current year, 15,000. When you add it, you have what? Net profit before tax is what? 55,000 naira. Take note, we look at the increase in the profit. That is the current year profit subtracted the previous year profit, and we got the net profit of what? Of 40,000. How much was provision for tax for the year? We have it here as what? As 15,000. Mind you, we're looking at the current year, not the previous year. So we added the 15,000 to it. We got 55,000. That's what we call net profit before tax. Before tax. Now, to prepare our cash flow statement, about 2012. Remember, you have to write the name. Title of the account is. For instance, if we are talking about a particular person, let's say in this question we have what? ABC Limited. We should have written ABC Limited here. ABC Limited, title of account, cash flow statement, and then the period for the year 2012, 2012. Very, very important. Title of the account, talk about, sorry, the name of the company or the business first, then the title of the account you're preparing. For this, in this case, we're preparing what? A cash flow statement or statement of cash flow. Then the period that we're talking about here is what? For the year ended 31st December 2012. Now, cash flow from operating activities. We have net profit before tax and extraordinary items. Of course, this is the profit before tax here, 55,000 naira. Without less income tax paid. Now, to get the income tax paid, we're going to apply that format. This format here. So the balance brought down of our tax is what? For the previous year is what? It's 10,000. Let's go. Can you see now? It's 10,000. Balance brought down for the previous year, 10,000 naira. Now, balance carried down for the current year. Current year is what? 15,000 naira. This one is the figure here, 15,000 naira. Now, in the P&L account, how much is shown? Of course, it's shown as what? As 15,000. But that will be shown in the P&L account as what? 15,000. That's the amount as what has been provided as what? As provision for tax. That's what will be there. By the time you add 10,000 plus 15,000, that will give us, 25,000. Now, this balance is 25,000, but to make up this difference, what? How much is the difference between this 15,000 and the 25,000? You just say 15,000 minus 25,000 is what? Is 10,000. That difference of 10,000 is what? Is the amount of cash paid during the year. Let me take it again. The balance from the previous year is balance brought down of 10,000 naira. Now, if you come here, during the period, this amount will be shown in the P&L account as provision for tax. That's what will be here. Now, in the same period, this will be shown as what? As closing balance. As closing balance of what? Provision for tax. In that case, you bring it down here. Balance carried down of 15,000 naira. So when you add 10,000 plus 15,000, will give us 25,000 naira. Now, this place will only have one entry. And to make this side equal to this side, what do? We say 15,000 naira balance carried down minus the total of 25,000 naira will give us what? 10,000 naira. This is what was paid during the year. Of course, this balance carried down the same amount that is here. So when you add up the net cash and the net profit before taxation and extraordinary items with what? Income tax paid, you have what we call net cash flow from what? From operating activities. That is how we treat the direct methods. Let's look at cash flow from investing activities. We're done with what? Operating activity. The next one is what? Investing activity. Remember, we said there are three subheadings. We'll talk about cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now we're going into cash flow from investing activities. Cash flow from investing activities, cash flow from acquisition or disposal of long-term asset or investment are termed as what? Cash flow from investing activities. In other words, this one has to do what? This buying and selling of what? Of long-term asset, of fixed asset, or a sale. Of course, that is what? As an cash, it's an inflow. But when you buy an asset, there's an outflow. Now, the important that this asset have not been held by the business concerned for resale. Take note, if this asset that you're selling are for resale, it means is what you term it as what as purchases or as these assets are bought with the aim of using them in the business. And then one day you decide to sell this asset. That's where we look at what a cash flow from what from investing activities. In this type of classification, cash flow representing the expenditure which have been made with the intention to what generate future income or cash flows. I've explained this. As per AS3 revised, that is one of the accounting standards. Following type of activity can be regarded as what cash flow from the example of activity that can be activities. One, or intangible asset. Research and what they are example of what activities. Cash, tangible or intangible. When you receive cash because you sold a fixed asset, whether they are intangible with cash flow from investing activity. Cash paid for acquiring shares, warrants, or debt instrument of other enterprises and or interest in some joint ventures is also cash flow from investing activities. Cash received from disposal or issue of shares, warrant, or debt instrument of other enterprises and or interest in cash in some joint ventures is also what cash flow from investing activities. Cash given as advance and loan to third parties is cash flow from what? Investing activities. Then cash received from the repayment of advances and losses given to third parties is what? Is also cash flow from what? Investing activities. Now we have the following formats. Cash flow from investing activities. Now, sales of fixed asset. Of course, when you sell fixed asset, it becomes an inflow. That is, the income is coming to the business or to an organization. So you put the sales figure here, not the profit, but the sales figure. How much did you sell the asset? Let's say you sold your motor vehicle. How much did you sell it? How much did you realize? Is the figure you put here. Now, when you purchase, that is, you're buying now, purchase of fixed asset. How much did you spend in buying the fixed asset? Because it is an outflow, you put it in bracket indicating what money is going out. It's a deduction. It's a reduction in what? In the value of cash in your organization. So you put it in minus or in bracket. Purchase of long-term investment of anything you're buying, anytime you're buying, the money is going out. So anything that will result to an outflow in the investment activities, it is put in bracket, meaning what? It is what? A subtraction or deduction or a reduction in the value of cash. Now, when we have sale of long-term investment, this one is sales. Supposed to be in brackets. Sales supposed to be what? An income. So it's supposed to be without the bracket. That's an error here. It's an income, it's an inflow. So it's supposed to be without the bracket. Now, interest received non-financial enterprise. When you receive interest, it's an income. Dividend received non-financial enterprise, it's an income. Then by the time you do the plus and minus, you get what we call net cash flow from investing activities. You get what we call net cash flow from investing activities. Let's look at this simple example. So from the following particulars, calculate cash flow from investing activities. Now, this is an asset. Machinery as at on 1st April 2011, the value was 80,000 naira. And then the same machinery as of 31st March 2012, the value has gone up to 90,000 naira. Then as of 1st April 2011, tuition accumulated was 22,500. Then as at 31st March 2012, depreciation was what amounted to 37,500. And we have the following additional information. So during the year, a machine costing 37,500 with actual depreciation of 21,000 sold for 18,200 calculates cash flow from investing activity. So this is what happened. We have the opening balance of the machine here. We have the depreciation for that machine at that date. We have the closing balance of the machine here. We have the value reduced by depreciation for that day is this. And during the same year, we were told that what the machine that costed this amount, 37,500, and it has depreciation of what 21,000 was sold. How much was it sold for? 18,200 naira. That was to calculate what cash flow from investing activities. Now let's go ahead. First of all, this is the working calculation of what cash flow from investing activities. Look at here, the sale of the machine, that is an inflow of 18,000 naira. But how much was purchased? Because if you look at the value of the machine here, at the beginning of, or in the previous year, the machine was 80,000. But what happened? That it has risen to 90,000 naira. There are two things that would have happened. One, probably the machine has been revalued upward, or there was an additional machine bought. But in this case, the machine was bought. Now let's go back and see. How did you get this 37,500 as what? Purchase of machinery. We have some working here. First thing we do is we're going to calculate how much depreciation that we have, accurate depreciation we have. Now, we have the opening balance of depreciation. Let's go back to the question. As the opening balance is what? 22,500, which is this one. Now, and the machine was sold at how much? Okay, with the how much when the machine sold, the machine that was sold, how much is the total depreciation for that machine? It was 21,000 naira. So in this case, to be on the debit side, out of this machine sold was what? 21,000 naira. That's depreciation for that machine sold. How much was the depreciation for that machine? It was 21,000 naira. Now let's go back. What is the closing balance of depreciation? Balance carried down of depreciation is what? 37,500 is the one here. 37,500. By the time you add 21,000 plus 37,500, you will get 58,500. Now, this is 22,000 naira. The difference between this figure and this is what? Is the P&L depreciation for the year. 36,000 naira. Now, let's go back to the machine account. This is the machine account. Machine account, okay. In the opening balance, that is debit side, the machine was what? As of 1st April 2011. But the machine was valued at 80,000 naira. That's debit side. Balance brought down 80,000 naira. Out of it, machine sold was how much? Of 37,000 naira. Look at it here. The value of the machine that was sold, 37,000 naira. Remember, when you have machine here, it means that this is a debit entry, an asset. Now, remember our principle of double entry. If we want to reduce an asset, we make the entry on the credit side. So this machine was sold. It means the machine was what? Reduced. The value of the machine was reduced by how much? By the amount realized from the sales. 7,000 naira. Now, 31st of March 2012. What is the value of the machine? That is the balance carried out the machine. Of course, it will be on the credit side. It was 90,000 naira. When you add up 37,500 plus 90, you get 127,500. Now, when you subtract this balance, 80,000 minus 127 minus, so 127,500 minus 80,000, you get the balance is what? Is the purchases. This is the value of machine that were bought during the period 47,500 naira. Let's go back to the next account, machinery sold account. Yes. What is the value of the machine that was sold? The machine cost, the cost of the machine is what? 37,000. So machinery account, 7,000 naira, 500. How much was depreciation on that machine that was sold? It was 21,000 naira. Now, how much was the sale figure? How much the sale figure? How much was it sold for? It was sold for 18,200. Of course, you put it on the credit side. That is, the sale account was what? 8,200. When you add 21,000 plus what is sold, we have 39,200. But the machinery, what's the cost of the machine? It was 37,500. So the difference between this amount and total here is what? 1,700. That would be what? The profits. That is, will be shown as what? As P and L account item. Now, let's go back to the solution again. We said computation of what? Cash flow from investment activity. This is sale of machinery. Of course, the selling value is here. That is what we actually realize is 18,500. And then out of it, we purchase other machinery. How much did you pay? Of course, if you see our workings here, we paid 47,500 naira. So we subtract it to 7,500 naira. So we have net cash used in investment activity. We have what? A minus of net 29,300. That's what net cash used in what? In investing activities. Now, any question so far? Any question? Mr. Adeoye, any question? Scholar, are you there? Any question from any of you?
Yes, I'm here. The other section.
Which one is that?
That is the accumul calculate.
This one?
Yes,
What about it?
accumulated depreciation. I don't know. This 21,000. How did it come?
This 21,000 is, let's look at it here. This is, look at it here. It said during the year, a machine costing 37,000 naira with what? Can you see this figure here? Accumulated
Yes.
depreciation with 1,000. That's why we got this figure. We
Okay.
got it from the sale.
Okay.
Yeah.
Okay.
Any other question from anybody? Mr. Doye, are you there? All right. So,
Yes, I'm here.
okay. Are we together?
Yes.
All right. Let's go to the last part of it. Cash flow from financing activities. Cash flow from financing activities. Cash flow from financing from these activities, which result in what? Changes in the shape and composition of owners' fund, including preference shares capital and borrowed fund of the business, are called cash flow from what? Financing activities. So we're talking about what? When this result is a change in what? In the shape and composition of owners' fund, which will include preference shares capital. In shares in company, we have what we call preference shares, we have ordinary shares. Preference shares rank first when it comes to what? When the company is going to be, when the company is about, or when the company is created. So what they do is they pay the preferred shareholders first. They pay whatever the company is owing them first before any other person. So they rank first in what? In payment of anything that happens. So they rank first. So These are when there's a change in shape and composition of owner's fund. It's called what? We say it is an activity from what? Financing activity. Some of the example of cash flow from financing activities include: one, cash received from issuance of share capital. Yes, when you issue share capital, it means what? It has changed the composition of what? Of the owner's fund. Probably you have a shareholder that was holding, say, 10,000 shares, and now you are now issuing out shares. Somebody may come and buy more than 10,000 shares. If you more than what, it has changed what? The owners, maybe the highest shareholder will not be there again. Maybe majority shareholder will now become maybe a minority shareholder. Depends on what happened. There's a change in the composition of what? Of owners form. Then we talk about what? Cash received from issuers of debenture and long-term or short-term borrowing. Debenture is also like a debt. A debenture, just like a document you give to somebody and then you collect money from the person, is a form of, as well as what? Short-term loans. They also what? They also activities for financing activities, because it changed the what? The composition of the shareholding or the owner's fund. Because if you're collecting loan, it means maybe your loan money, your loan capital will be more than and shape. Then what about repayment of this loan? Of course, it's an outflow. What about payment of dividend? Of course, when you pay dividend, it reduces from what? From your capital, from your owner's fund. Let's look at this example. For the following information related to ABC Limited, calculate cash flow from financing activities. Number one, 2,000 equity shares of 10 naira per 2,000 equity shares of 10,000 share, which is 10,000 per share, were issued at par. At par means at the same price. There was no profit, there was no discount. There was no premium, there was no discount. So share can be issued at par, at discount, or at premium. When we say at par, it means at the same value. When we say at premium, it means there was a profit. If the share value is 10 naira and the shares are issued at, let's say, 11 naira, there's a profit of what? 1 naira. Then that shares, or those shares, are issued at what? At premium. But when the share is 10 naira and this share are now issued at less than 10 naira, it means as what? The shares are issued at discount. Now, number two says 8% preference shares of 10,000 were redeemed at a premium of 10%. Then lastly, dividend paid of 2,000 naira. Now, we're calculating what? We're computing cash flow from financing activity. Now, the first thing is what? Issue of shares. Issue of equity shares or ordinary shares. How many shares were there? 1,000 shares. And how much was each share? 10,000, 10 naira. You will not say, okay, 10 naira multiplied by total number of shares issued. That is 10 times 10, 10 times 2,000 give us what? 20,000 naira. Now, when you're redeeming shares, it means what? Sorry, when you issue out shares, it means there's what? There's an inflow of cash coming to the organization. That's why we have what? A positive amount of 1,000 naira of that shares. Now, when you're redeeming shares, it means you're paying money to your what? To your preferred shareholders. Look at it. It said 8% preferred shareholders of 10,000 naira were redeemed at a premium of 10%. So a premium of 10% is what? This share is what? 10,000. And each share, they have what? A profit of what? 10% of it. By the time you multiply 10% of 1,000, of 10,000 will give us what? 1,000 naira. So they're going to pay for the premium as well as what? The face value of the shares. The face value of the shares is what? Is 10,000. The premium is what? Is 10%, which is 1,000, making it what? making it to be 11,000 naira. That is 10,000 profit plus 1,000 profit plus 10,000 value of the shares. Then, since you're redeeming these shares, your what is an outflow of cash. Of course, money is going out. Then when you pay dividends, it's also an outflow, and it reduces what your cash flow from from financing activities. I tell you, you subtract 11 and 2,000 from 20,000, you'll be able to get 7,000 as what net cash flow from financing activities. Net cash flow from financing activities. Is that understood? Any
Repeat
question?
how we got that 11,000 again.
Okay, 11,000. Let me see whether I can do it for you. Let me see whether I can show you. Let me just stop sharing the screen. And let me see. Let me want to use what is it? Oh, let me use a whiteboard. Hope you can see my whiteboard loading. This is the amount. How much is it? 10,000 naira, right? This is the amount of the preference shares. 10,000 naira. And these shares were redeemed at premium of how much? 10%. So what you do is you can say it multiply by 1.1. I know you asked me how do I get 1.1?
%10.
That's 10%. That is correct. That's how you got it. Or it's okay. How much the value of shares? 10,000. Let me just do it this way. 10,000. That's the value of shares, 10,000. And what is the value of the cost price of that share? Is 1 naira. 1 naira. 1 naira. That will be equals to what? That will be equals to 10,000 naira, right? That is at par now. That's what the value of the shares at par. 10,000 naira. Now, apart from this one, these shares were redeemed at premium, that is at a profit. So 10% is something as what? 10 over 100 over 100 multiply by 10,000. That gives us 1,000.
Okay.
That gives us 1,000. Now, when you add this 1,000 plus this 10,000, give us what? Will give us 11,000. That's how we come about this 11,000 naira. Now, for me, I wouldn't go and begin to do all these things. I know that 10% is what? Is 1.1. Because 10% is 0. 10% is what? 10% is what? It's like 100 bar.
Yeah.
Same thing as what? As 0.1. So this one, it refers to what? The initial value was what? 1 naira. So there's an increase of what? An increase of 1. So I also have 1.1. If we have 20%, it will be 1.2. We have 50% will be what? 1.15. It depends on the percentage increase. Multiply, you give you the principal plus or the face value and then the profit or the premium together. I hope it's clear.
Yes.
All right. Let me go back to my screen. Can you see my screen up till now?
Not showing yet.
Okay, okay. Sorry, fingers. Hope it's visible now.
Yeah, it's coming up.
All right. Now this is so I said to now determine whether it's an increase or a decrease in cash and cash equivalent, what do? We compare the opening balances and the closing balances of what? Of our current assets. Let's look at the first thing is what? Cash in hand. That is what you have at hand as a business, maybe in your safe. Opening balance, let's say we have an amount XXX. Closing balance, we have XXX. Opening balance is the balance as at last year or at the beginning of this year. Closing balance is the balance as at the end of this year. What is the total cash that you have? We have XXX. Then we cash at bank. How much do you have at the beginning of the period? And how much do you have in the at the end of the period? You compare it. What you do is subtract this and this. Let's say this was 10,000. This is 15,000. Of course, there's an increase of what? 5,000 naira. Let's say cash at bank, you had 3,000 naira, and then closing balance, you have 5,000 naira. There's a decrease of what? 15,000 naira. Short-term investment, what is the opening balance? What is the closing balance? The difference, is it an increase or a decrease? Then the total. Now, this is a comprehensive format of the cash flow statement or statement of cash flow. Remember, I said it has the name of the account must be up there. Let's say we have ABC Limited, the cash flow statement. Then for the year ended, you also have to write this one, because anybody reading your cash, which cash flow is for which particular period of time. So we said for the year ended 31st December 2022, 31st December 2024. It depends on which year you close your account. It can be 31st December or 31st January 2023, or whichever month you have your account closes. So it has to be indicated here. Then we have particulars, we have amount, naira. What, assuming that we're dealing with nairas. Then the first thing is what? Cash flow from operating activities. Remember, we've done this one. Net profit before tax and extraordinary items. You bring your net profit there. Then you make adjustment for what? depreciation, you add it back. When there's a loss on sale of fixed asset, you add it. When there's a gain on the sale of fixed asset, you subtract it. When there's a loss on the sale of foreign exchange, you add it. When there's an interest received, subtract it. When there's a dividend received, subtract it. Of course, you get the figure here. That figure is known as what? Operating profit before working capital change. This is what we call profit before working capital change. Now, you now add a decrease in current assets. A decrease in current assets. Let me go back to my example. All these ones are current assets. A decrease in current asset. For instance, if 2022 opening balance is 10,000 naira, and at the beginning of the period, we have 10,000 naira as our opening balance of cash at hand or cash in hand, then at the closing balance, we have 5,000 naira. It means is what? The cash, the current asset is what? Is decreasing. By how much? Let's say 10,000 opening balance minus the closing balance of 5,000, we got what? We get 5,000 naira. So the decrease is what? Is added here. What about liabilities? Of course, if there's an increase in liabilities, you add it. For instance, creditors was 10,000 naira at the beginning of the period, and then at the end of the period, you have 25,000 naira. Of course, you will ask, okay, how much were you having at the beginning? 10,000. How much do you have presently? 25,000 naira. The difference between 25,000 and 10,000 is what? Is 15,000 naira. That's what is an increase. So you add it to. You add this to. That is, a decrease in asset and an increase in liability. When you add them together and then bring a figure here. Then conversely, or in the reverse order, when there's an increase in current asset, you subtract it. When there's a decrease in current liabilities, you subtract it. By the time you do this together, you add it, then you subtract it from this total. You get what? Cash generated from operating activities. Cash generated from operating activities. Now, having done that, you will now look at, okay, how much income tax was paid? How much was tax paid? You subtract tax from this one. You have what? Cash flow from cash flow before extraordinary items. Then we'll talk about what extraordinary items when they occur. If the item result to an increase, you add it. If it result to an outflow, you subtract it. That's why we have plus or minus here. By the time you add this, you have net cash from what? Operating activities. It stops here. You finish what? You finish with what? Operating activities. You pick the next one, what? Cash flow from investing activities. And it's received from the sale of fixed asset. When you sold asset, how much did you sell it? You write it here. When you buy fixed asset, how much do you spend in buying the asset? You write it in bracket. That is a subtraction. When you receive interest, you add it. When you receive dividends, you add it. When you sell investment, you add it. When you purchase investment, you subtract it. Write the figure here. That will become what? Net cash flow from investing activities. Then the last one is what? Cash flow from financing activities. Proceed from issuance of share capital. When you issue shares, how much did you receive from the shares? You write it here. Then proceed from long-term investment borrowing. That means you borrow money for the business. That is an inflow. Of course, even though it's a debt, it's an inflow to the organization. You put it here as a positive. Then when you proceed from long-term borrowing, your proceed in paying this one. How much? Proceed is what, when you have proceed, this proceed is what is deducted from what? From the long-term borrowing, from the other items. Now, when you have repayment of the loan, it is a minus. Then we have interest paid, a minus. Then we have dividend paid, a minus. By the time you add this and less all this one, you get a figure. You have net cash flow from financing activities. Now, net increase or decrease in cash flow. Well, by the time you add this 1, 2, 3. Some of them will be minus. We have maybe minus, plus, minus, minus. When you have the last figure here as a minus, becomes a decrease in cash and cash equivalent. When you have a plus here, positive figure, it means what? A net increase in cash and cash equivalent. So what do? We look at, okay, at the beginning of the period, cash and cash equivalent at the beginning of the period, how much was it? When you add it together, after you add it, you have what? Cash and cash equivalent at the end of the period that we are reporting. That's what? That is the end of your what? Cash flow statement. That's where we stop. Finish your cash flow statement. Any question? Any question from anyone? Any question from anyone? Now, if there's no question, I want to break this training because I would like us to pick a question. We work together from the beginning to the end. I don't want to start the question and then stop halfway. So we'll meet on Thursday by the grace of God, pick the question, and then work it together. Is that okay by everyone?
Yes, okay.
All right. So please, but you can go through the audios. I mean the recording. Sorry, go through the recording, get a better understanding, so that we pick the question. We look at how we apply this step, these techniques we've learned. We see how we apply them, and then see how we can go about it. By the grace of God, we'll run up this topic on Thursday. We'll pick very comprehensive question. So we'll take our time, explain, go back to the format, go back to the explanation, then make our posting based on what we understand. And then let's see how we can go far. All right. If there's no any question, we'll see you on Thursday. Good night.
Thank you, sir. Good night.
You're welcome.